All right, today we're jumping into the truly wild story of CoreWeave, a company right at the center of this massive AI gold rush. And it's a fascinating tale, really, because it's about mind-blowing success hitting a totally baffling wall, and it tells us a ton about the real-world physical limits of this digital boom.
Okay, so let's try to wrap our heads around this puzzle. On one side, you have a company posting absolutely stellar results, inking deals worth billions. On the other side, the second that news drops, its stock price just falls off a cliff. I mean, how does that even happen? We are going to break down exactly what went on here.
First up, let's just talk about the good news. And when I say good, I mean, it was incredible. The numbers here paint a picture of a company that's basically strapped to a rocket ship.
So for the third quarter, CoreWeave brought in a staggering $1.36 billion in revenue. And that didn't just meet what analysts were expecting, it completely blew past it. The street was looking for about $1.29 billion, so this was a huge win.
But here's what's really crazy. Look at the speed of that growth. A 134% jump in revenue compared to the same time last year. That's the kind of triple-digit growth that gets investors so excited about the whole AI space.
And this wasn't just some fluke, right? This growth was fueled by locking in these massive long-term deals with the absolute titans of tech. We're talking OpenAI, Meta, and Nvidia. I mean, these are the companies literally building the AI revolution, and they are all depending on CoreWeave.
So you're looking at all this and thinking, wow, this is amazing. Record revenue, explosive growth, huge new contracts. You'd think the stock would just skyrocket. But that is not what happened. Not even close. Wall Street's reaction was, well, the exact opposite.
Instead of champagne corks popping, there was a major sell-off. The company's stock plunged 9% before the market even opened. And this, right here, is the paradox. All of that amazing news just got completely steamrolled by something else. And here's the culprit. It was their forecast for the future. You can see the problem right here. They said they expected to make over $5 billion in 2025, which is an enormous number, but it was just a little bit less than what analysts had been hoping for. And in the world of these super high-growth stocks, missing future expectations, even by a little, can be a really big deal.
But that just makes you ask a deeper question, right? Why on earth would they lower their guidance when demand for what they do is clearly exploding? What could possibly be powerful enough to put the brakes on a company with this kind of momentum?
And the answer is kind of wild, because it's not about a lack of customers, and it's not a tech problem. It's way more physical than that. It's a story about construction, about power grids, about the actual buildings that make the cloud work. CoreWeave CEO Mike Intrator, he was super upfront about it. He told everyone the problem was a delay at one single data center, and he got really specific, pointing to something called the powered shell as the main issue.
So, what the heck is a powered shell? Okay, think of it like this. It's a giant, specialized building where the power is already hooked up, the heavy-duty air conditioning is in place, but it's empty. CoreWeave has to be the one to come in and install all their expensive servers and networking gear. So they're literally waiting for the construction crew to finish building the house before they can move their stuff in.
And this is where you can see the massive ripple effect. A delay at just one of their 41 data centers forced them to lower their guidance for the next quarter. It made them shave $150 million off their big 2025 forecast, and they had to slash their spending plans. It just goes to show how tight the logistics are in this business.
So you've got this wild mix of news, right? Incredible growth on one hand, and a very real physical bottleneck on the other. So how did the financial experts, the Wall Street analysts, make sense of it all?
Well, you can see a pretty clear pattern right away. JP Morgan actually downgraded the stock. Others, like Bank of America and Mizuho, cut their price targets pretty significantly. Even the analyst at Jefferies, who's still bullish on the company, had to trim his expectations, just acknowledging the reality of this short-term delay.
But here's the key thing. Their concerns weren't really about CoreWeave's business being flawed, it was all about timing. Basically, the revenue they were supposed to get now is just pushed into the future. It slows down that incredible momentum, and maybe most importantly, it's a stark reminder that even for a cloud company, growth can be limited by real physical stuff.
So what's the big lesson here? When we look at this whole story, is it just the normal growing pains of a company expanding at an insane speed? Or is this a big red flag about some deeper problems for the AI industry?
And the debate really boils down to these two different ways of looking at it. On one side, you have the optimists, the bulls, who say, hey, this is just a hiccup. It's a temporary supply problem that's going to get fixed. Demand is still off the charts. But then you have the more cautious view, the bears, who say, whoa,
They cut their forecast. This proves that the AI boom has real physical limits that could slow everything down. And that really leaves us with one last big thought. CoreWeave's problem with a single building is such a powerful reminder that this AI revolution, it isn't just about code and algorithms floating around in the cloud. It's built on a very real, physical foundation of concrete, steel, and just massive amounts of electricity. So this isn't just a problem for one company, it could be a warning sign for the entire industry. The future of AI might be decided less by software engineers and more by construction crews and the people who run our power grids.